Hey, welcome back, Boise Entrepreneur Week. Really excited to close out the day here, having maybe a little bit different of a conversation than what this continuous conversation has been all day. Since we have the illustrious Matt Price here to chat, I think it'd be fun to spend some time talking about maybe a theme that we hear coming up a lot with entrepreneurs, a lot with startups, which is fundraising, right? And maybe we can talk about the misconceptions of fundraising, or maybe some of the pitfalls that I hear and I see, especially walking around an event like Entrepreneur Week. And so real quick, why don't we just a quick minute intro to Matt so we can all establish why we should listen to anything you have to say.
I don't know if that's a stretch. What's up, Entrepreneur Week? My name is Matt Price. I am founder of Price & Partner. We are a consultancy studio focused on seed stage corporate development. So touching on the fundraising topic and also providing kind of fractional executive help to these companies. On the board of Killer Creamery, on the board of Teton Valley Brands, and a venture partner for Kinetic Ventures.
Yeah, and Kinetic Ventures, of course, are attached to our pitch competition.
They write a big check.
Yeah, big check, $100,000 check. So
I mean, I tried to get them to 200, but
well, we
next year.
Appreciate the effort. Yeah. So I think something that when we talk about misconceptions around fundraising, I think a lot of times it's really important to start with entrepreneurs understanding what kind of business they're operating, and therefore what kind of financing or fundraising options are open to them.
Sure.
And there's a few different kind of buckets you could list in that, but one that I think is really interesting is I see a lot of entrepreneurs who don't have companies that really qualify as like a startup, spending a lot of time, a lot of effort running around trying to raise venture capital, which is really a vehicle for startups, and they have some specific kind of characteristics that make them a startup. Sure. So maybe you could just tell us what are those characteristics, what makes a startup right for venture capital, and what makes maybe some more traditional businesses wrong for venture capital.
So you're right. I think that we broadly lump all startup investing as venture capital. Right. It's like this blanket thing that you go talk to VCs, and VCs could be, they could be known as like the angel investor, they could be a formalized fund. I think we too broadly associate venture with startup funding. To your point, I think keeping in mind that venture capital works on a power law basis, meaning one or two companies per fund need to return the sum of that fund. So the companies that they're building, that you need to be building to take $3, $5, $10 million and make them really big outcomes. I mean, now we're talking about, in this ecosystem, we're talking about a handful of companies, not every company.
Right, absolutely.
And even venture works different in CPG than it does tech.
Right.
And you're an investor in both tech and CPG. What do you think about the way capital is different in those two asset classes?
Well, certainly, I mean, to be honest, when I look at the CPG market and I look at venture investing, it seems really kind of infantile to me in a lot of ways. I think that there's still a lot of question marks around how to make the model of venture work for an environment that doesn't have quite the same resource allocations that tech does, right? One of the great things about tech investing is you can test and scale up without actually having to raise a bunch of labor costs or whatever as you're doing it. And you don't have that quite as much in CPG, right? No. You're at least outsourcing to co-packers and all these different stuff. So I think venture is still trying to figure out how to be as good of a partner in CPG as it is for tech, which it was really kind of invented for.
It definitely was invented for tech. And I think the reason why CPG investing is so hard is because if it works, it's still an incredibly capital intensive effort. And the amount of first time founders and operators that are able to execute with that much capital and to continue to put the funding together incrementally, I think is it's a small group, and that's what we're trying to figure out here.
Right.
Number two is I can only sell a bag of potato chips one time.
Right.
I can sell a piece of technology 10 million times.
10 million times, yeah.
And if
your Amazon costs scale up, but that's it. Right?
But the CPG founders, and look, I came here to build an CPG ecosystem, not specifically to pounce on it. But I would say from a CPG operator perspective, I think you have to keep in mind that what we don't do enough is we focus on the big story in the pitch. We don't focus on the use of funds. We don't like get nuanced into like, okay, Nick, I love your startup. I love your story. Like, but let's get real. Where's the money going?
Right.
And in CPG, it's tough because if you're not really careful, the outside capital goes into subsidizing OpEx losses.
Right.
I mean, like that's my investment into your CPG just went to your burn rate, and it didn't go to any IP. Tech, it kind of flips around. So I think there are better. I don't think long equity is the right holistic strategy for CPG. I think that's like finding ways to use traditional debt. Kevin Learned's fund works great. Sage works great for kind of the earlier CPG
That's like
stuff.
a revenue-based financing. So they're looking at kind of revenue outcomes and doing financing based on that, which is a very creative way to fund some of this stuff.
I think he's probably doing well with that since the capital markets pulled back.
Yeah. Well, and so, outside of CPG, which I think, venture is still trying to interact with, we know venture is kind of built for tech. I think that a lot of folks probably are kind of scratching their head trying to figure out where their business falls into this. I mean, we have kind of traditional financing through like a bank, usually needs a couple of years of like strong revenue to draw on, since the bank's really looking at your books trying to figure out. And most entrepreneurs aren't sitting there. Most entrepreneurs aren't sitting with 2 years of the black, right?
Right.
And then it's a question on if you really even need the money to begin with, right?
So 100%.
And so, how do entrepreneurs that don't fall into kind of a traditional venture pipeline, obviously we talked about Kevin Learned for a second. What else should they be looking at? What other ways should they be thinking about raising capital?
God, that's a good question. Spanning across a bunch of different industries. So if we I think angel money, early angel checks, so your $25,000, $50,000 checks, local people holding hands, I think that's a good start for anyone. I think you can do that to give any company a start. But after that, I think it really depends on what you want to fund.
Right.
Like we just closed a big round for Teton Valley Brands, and part of that round was, again, like the use of funds was actually tied to, the bulk of it was tied to like actually hard asset machinery. Like we used, and that was an acceptable source of long equity.
Right.
I think understanding like what you're managing the business towards and how quickly you're trying to get there is probably a couple questions I'd be asking.
Well, and that last part is probably one of the most important things when you're thinking about the types of capital. Because again, like venture is trying to accelerate a company, in some ways almost profits be damned to growth, right?
Totally.
And that's a very different outcome and timeline than, say, someone who's trying to build a business that will sustain them and their family for the rest of their life, right?
Totally.
An entrepreneur trying to do that, and the pull and the energy is a little different there too on what you're required to do to get that capital. So no, I think that's great. The acceleration of the timeline, I think that's a big part of how you make these decisions and why you
And if the answer to, if you're a first-time founder in Boise, Idaho, and you're talking with investors about when they could maybe get their money back, if that answer is a day under 10 years, I think you got to rethink things, because I really think like that path is a 7 to 10 year window,
right?
On average, and especially for first-time founders in an ecosystem that we're getting more access to capital. But again, we're still pretty far behind in terms of venture exposure and active investing here.
Yeah. Well, and maybe kind of the theme of this conversation too is any founder who's looking at this problem in their business and trying to figure out their growth strategy and what they should be doing, they need to have a lot of conversations with people who are kind of in this space trying to figure it out themselves, or have already figured it out, or already had some success doing it. But knowing what your own goals are and starting from that place is really where you have to start before you can even go out and have a lot of those conversations and start asking for advice. Is knowing where you want to go and what that story that you want to tell is will make a big difference on the kind of capital, the kind of advice you're going to seek, the kind of people that you're going to try and bring under. So I know we're like close on time here, but maybe that's like we got there.
I think I don't think we got yes, I think we talk a lot about the true north, and I think you as a builder of technology and technology investor, again, like if you're putting together your first company and you're just ideating on it, if your second or third thing is I need to find investors, I think that's a mistake.
Right.
Like there are plenty of customers to talk to. I think like trying to get the business off the ground, using sales is good. At least using feedback from customers as opposed to using, names of advisors on a pitch deck.
Traction now is probably the most relevant thing to pitching your business. And in some ways that's true of course, when you're going for traditional financing. It's true if you're doing venture. It's true if you're even just going to friends and family and trying to convince them to invest in your idea. Is that proving out that there are customers that want what you're doing?
Yeah, totally.
Is far more powerful than, to your point, advisors on an advisory board.
Unless your name's on the deck.
Oh, well.
And then in that case,
don't listen to Matt Price. We made a mistake.
Shell it out. You made a mistake.
No, I think that is a really important step. And I used to joke all the time that revenue is the seed round, right? Like you can get pretty far. Our company was all built on revenue. We never took outside capital.
Totally,
and like maybe you have a slightly slower growth curve or whatever, but you can build a very stable foundation kind of taking that approach.
The thing about taking investment right off the bat is it's kind of like it better work.
Right.
Because once you've taken outside capital the first time, your entire business depends on you either making that up in sales and profit or meeting the criteria for the next check. And again, you miss with outside capital, those misses are brutal. And a lot of times companies don't quite survive that.
You could have some companies that otherwise would have a shot at success, but the type of capital they took and missing that next check, it happens all the time. That company goes under, not because they don't have an actual shot at success, it's because they miss the metrics that are required for the next raise of capital.
Totally.
See it all the time. So, again, just thinking advice for founders, that this is stuff that I know you and I talk over lunch all the time, and just kind of hearing some of the conversations as we walk around today. I thought it'd be fun just to have this conversation. I've interviewed you before. You've interviewed me before.
No, I think takeaway advice would be, and I've been telling this to a lot of founders, especially in a capital scarce environment, where you're starting to see a lot of early first-time founders that are kind of molding their plans around what they think investors want,
right?
Not necessarily like the plan that they can execute. And
right.
I would say, don't be changing your plans to have other people's money fit into it. Like, pick your plan, stick to it, show traction, and find the right financing for that plan. Otherwise, you're it's really difficult right now.
Right, and the execution's far more important anyways than any of it. So, well, anyways, listen, we're closing out the day on the continuous conversation. It's really great having everyone tune in. It's really great to be down here at Boise Entrepreneur Week. We're going to leave you with a couple words from our sponsors, and thanks for tuning in.
Thanks.